So, one of the things about this subject is to arm you with information that you will actually use. I guarantee you the stuff you will learn tonight, some fraction of it will be in your head and you will make life decisions, not just technical, tactical, strategic business decisions, but actually life decisions based on some of the stuff. I kid you not. Yeah. Um, so, unless anyone's got any questions, I'll get started on it. If that's all right. It's not exciting because in ye old days, if you managed to convince the tax office that a particular transaction was capital and not income, you didn't pay tax on it at all. You literally didn't pay tax. Now, look, they tried to get around this, the tax office, by putting in these rules in the old act. None of them are very effective. They're very easy to bypass. And ultimately, that led the Hawke government to basically map out how capital gains are going to be included in income. And that came in effect on the 20th of September 1985. Now, there's a common theme here amongst all of the CGT rules, which is that they do not apply retrospectively in most instances. What does that mean? That if you enter into a transaction to buy something and you bought something before the 20th of September 1985, for example, that thing is not subject to CGT. And it's a very it's actually a pretty important theme. And this is more of liberal democratic societies where you don't tax people retrospectively. You don't say, well, yeah, you've ordered your life in a certain way. Now we're going to change that. And what you're doing means that what you did back 20 years ago, you're going to have to pay tax for. We don't do that. The downside is whenever they change the CGT rules, you have to know the changes and you need to know the old rules. That's one of the unfortunate consequences of this. So you will see a lot of dates that come up and you'll need to know when assets, usually when assets were acquired, in regards to those things, because assets acquired before certain dates can be under different rules. Okay, so that's one thing you need to know. And one of those rules, by the way, is 20th of September 1985. If you get a question which says you purchase or the taxpayer purchased an asset before, in 1984, and then they sell it now, no CGT, no capital gains tax at all. Okay, so that's the first thing to note. Right, second thing to note, in every income tax year, your net capital gains are added to your assessable income. And we know that assessable income is the raw amount before we're having allowable deductions. And once we do that, we find our taxable income. Then we apply the tax scales, and then we allow for offsets and credits, and then that amounts to tax payable. Now, where it says net capital gains, are all capital gains reduced by capital losses, then the relevant discount percentage? Yeah, when we talk about this relevant discount percentage, that it's towards the very end of this lecture, and it varies by entity type and also how long you've held the asset. But the key words that we need to note here are these ones. Net capital gains, that's the sum of all of the capital gains you've made in a particular tax year. Reduced by capital losses, they are all losses that you've had in terms of capital transactions, both in the current year and previous years. And we'll talk about discount later on. But what is a capital gain or loss? It's when a CGT event occurs in regards to a CGT asset. So each of those phrases, you're going to have a functional understanding of. So that's what that is. We know what assessable income is because we've talked about that for 4 weeks. Okay, so we're going to go through these in turn. We'll talk about the different types of assets, then we're going to talk about different types of events, then we're going to talk about losses and discounting. And big 24 for me. Oh, awesome. Not technically a mature age student yet. Good. What's a CGT asset? Pretty much everything. They're like literally, they basically, when they wrote this piece of legislation, they wanted to encapture everything. They wanted to have a regime or a system whereby all types of assets were going to be included, and they didn't want people to get out of it. That's essentially how that works. And oh, good golly. Um, okay. And I've just had a whole bunch of things pop up on my screen. One is that my AFL team is getting flogged, and the other is that the trivia night's on. Did you guys? I don't know, Stacey, you're in Townsville. You didn't go to trivia night.
Since I started working like full time, I have no idea about any of the events or anything that's going on anymore.
Okay, well, everyone's down there now, downstairs. A couple of things to note about this, where we talk about CGT assets, is where we're looking at when we're looking at assets, obviously real and personal property are going to be CGT assets. Shares are an important one, and note that units and unit trusts are pretty much the same things. Other things, though, that aren't intuitive, debts, where you've got contractual obligations, they are going to be CGT assets. Also, non-Australian currency is a CGT asset. So if you buy or acquire foreign currency, and then you have an event regards to that, that's going to be that. I've put cryptocurrency here. I've also technically that's NFTs and other things as well. But the idea is that if in most situations these intangibles are going to be CGT assets. Now, most assets are actually treated the same. There are some particular ones in the CGT regime which are treated differently. Collectibles, which is an exhaustive list, personal use assets, and this broad category known as separate CGT assets. That's where you've got one particular asset, but there's some components of it that need to be treated separately. So I'll go through each of these in turn. First one, collectibles. Collectibles are an exhaustive list. So the Act maps out a list of things and says these are collectibles. And the one important rule to note about collectibles is that where you have a loss from the disposal of collectibles, that is only going to be offset against gains from other collectibles. You can't lose money on your collectibles and then try and offset that against gains elsewhere. Parliament's onto you as part of that. Okay, so that's just one thing to note. Also note that where you've got collectibles, if you acquire them for a small amount, what's that when you acquire them? $500 or less. The gains or loss from that when you dispose of it are going to be disregarded as part of that. Now, you have to be a little bit mindful when we talk about a collectible, because if you dispose of a bunch of them at the same time, they're going to be deemed to have been the same thing, or they're pulled together for the purposes of that. So the tax office doesn't stipulate whether it has to be in the same transaction, but note if you are advising people on this, it's within the same tax year is where you're going to have to go through and pay attention to that particular rule. Okay, so when I say it's an exhaustive list, what does that mean? It means that it is only these things. You do not, if it doesn't fall within this list of objects, it is not a collectible. It may still be a personal use asset, which we'll talk about in a second, but it is not a collectible if your asset is one of these types of things and it has a gain or a loss. In regards to those things, if you acquired it for $500 or less, you ignore it. If you make a loss on disposal of it, you can only offset that loss later on against gains from others of these collectibles. That's the key thing to note about that. Look, there are some particular things, that list, by the way, because it's exhaustive, these things are not collectibles. Other things that we collect these days, Figurines, toys, and sports and other memorabilia not going to count as collectibles as part of that. NFTs are a contemporary phenomenon. Again, that's when you take artwork and you turn it into, you basically turn it into a digital encrypted version of the same thing. That is not going to count as a collectible. It still may well be a personal use asset, not a collectible as part of that. So look, in regards to antiques, which are on the previous list, where antiques must meet these conditions. It has to be of artistic and or historical significance and be over 100 years old. That is the ATO's position on what an antique is. That is quite a lot, by the way. 100 years is a long time. So if you have items from the 30s, they cannot be antiques. Okay. Coins are an interesting one. Normally, coins, you see, collectible coins will be considered to be collectibles. However, you've got this one here. They have to exceed their face value. What's the face value? Stacey, what's the face value of a coin?
Whatever it says on the coin, I'm assuming.
Bang on. Yeah. So if the coin says 20, I don't know, 100 Australian dollars, if you're buying the thing for 50, then it's not a collectible. Also, if the spot price, which is the base metal price of their metal content, so if you have a gold coin, it has to be worth more than the actual value of just the gold as part of it. That's where that sits. So that's what you need to do. And so, yeah, those are just some extra rules, some things to note. Note that cars, it's not so much that even the word classic, we'll talk about it a bit later on. Cars are not CGT assets. There's an exception for that. We'll get to that. Okay, personal use assets. This is the key rule we need to know here. It's this rule here. Oh, where's my pen going again? Right, it's this one here. The reason why we are interested in this, you don't have to take into account gains from CGT assets, provided you purchase them or you acquired them for less than $10,000. So if you buy a jet ski and then sell it for more, not a capital gain unless you spend more than $10,000 on it. That's what you need to know from that. Also note, if you lose money in personal assets, you can't offset that against your future capital gains either. So those types of assets are not, look, they can be subject to CGT, but usually they aren't. Largely that this rule was put in place because we just don't care. People buy stuff all the time. You don't have to do that. Oh my God, my team's getting flogged. Oh, I've got the score over there. One thing to note about peculiar types of personal use assets is this one here. If you loan money to family or friends, that is a personal use asset in regards to the CGT regime. Okay, so just make note of that. So if you are loaning money, again, that's just have to be mindful of that. That falls under this regime as part of that process. Crypto. Oh, I put the slide in just recently. A couple things about crypto. It is a barter transaction. It's not currency. It's not foreign currency. It's not a personal use asset. And we'll talk about the types of CGT events, which A1 is the most common event. So with crypto, if you buy it with the intention of making a profit on disposal, it's going to be income. It's income. That's an ordinary income in the ordinary sense. And if you're a crypto dealer and you're buying crypto and selling it, well, you're a crypto dealer. That's your trading stock. That is literally your business. And so when you buy it, it's a deduction, and when you sell it, it's revenue. That's how that works. Okay. All right. So the third type of unusual assets are what we call separate CGT assets. They are assets where you have to account for them separately from everything else that they're attached to or that they're sitting on. So there's two basic rules for this. Look, where you've got anything that's put on land where the land was purchased before 1985, you have to account for it separately, regardless of whether it's improvements to the land or regardless of whether it's building or fixtures or fences and other bits and pieces you put on there. They have to be accounted for separately. Do you guys remember the difference between Division 40 and division 43. This is depreciation. This is capital works. What's this one? Can we get that? I think it's 40. I think it's 40. What am I drawing? Black hole. Yes, that's it. So these are the three types of ways that you can deduct um, capital expenditure, either through depreciation, through capital works, or through black hole. And so that's the those are the three ways. Now, the important thing to note is that capital works applies to when you're going and you're basically just improving land, but not through things like buildings. It's where you're going and you're digging things up and moving things around, and you're doing things that are actually just increase the land themselves, not the buildings on the land. With the point being that when you do those works, they don't get written off over a period of time. Buildings degrade. When you put a building up, eventually, some stage you're going to have to replace it. That's a depreciation. Um, that's depreciation for the purposes of tax law. It's depreciation for the purpose of accounting. When you do capital works, you're improving the value of the underlying land itself. Does that kind of make sense? And the black hole provisions are for things that fall between the cracks. They're for asset types that don't fall into either of those categories. Okay, that's the difference. So I guess that's actually pretty important delineation to make in terms of understanding where those things fit. That's the stuff from last week. But note in regards to CGT, if it's a pre-1985 asset, both Division 43 and Division 40, they must be accounted separately. So if you buy land, you bought land before 1985, then you go to improve it, you're going to have to account for that as a separate CGT asset. If you've bought land after 1985 and you've got improvements on it that you're going to depreciate, those have to be accounted for separately. Okay, that is different and distinct from the capital work. If you buy land now and you do capital works on it, that doesn't form part of CGT. It just doesn't. As part of that, you're not. Why? Well, when you dispose of the land, it's going to form part of cost base. You're going to have to, in theory, your proceeds are going to be higher. So that's where that sits. All right. So those are CGT assets, and now we're going to look at events, or rather, we're not. Why? Because there's squillions of them, and ultimately, you will come across this event, for all those that end up in practice, you're going to come across against this event. I would estimate 99.9% of the time. You will come across this particular event, 0.05 maybe, and you'll come across against this event, 0.04% of the time. So the thing is, what do I mean by that? Well, if you dispose, you sell, you somehow swap away, or you get rid of a CGT asset, that is an A1 CGT event. If, however, your asset is destroyed, that's a C1 event. And in the occasional moment in business practice where you create usually a contractual right, although the others can also form there as well. If, for example, I'm selling my business to you, Stacey, and my business is to sell musical equipment in Townsville, and I sell a business for $1 million. The stock is all of the inventory in the buildings is $1 million. I'll pay you. I'm selling you, so you're paying me $1 million for the stock and for the buildings. You're paying me $200,000 for goodwill, and you also pay me $100,000 to not compete in destruction of CGT asset. It's easy. Cyclone Yazzie created a lot of C1 events. It's where your asset's destroyed. So you've got a building, got wiped out. Yeah, building's gone. I love this. My collectible card that is valued at whatever it's $15,000 US. If that got just stolen, that would be loss or destruction of a CGT asset. But that's a C1 event. In regards to a D1 event, if, going back to my example, if I'm selling my music business, Stacey, $1 million for the physical assets, land and stock, $200,000 for goodwill, and $100,000 that you are going to pay me for me to not open up another store. So in other words, to not compete against you, you will pay me $100,000 for me to not open a music store in North Queensland for 5 years. That third type, that's a D1. That's a D1 event because I'm creating a contractual, legal, or equitable right in another entity. I'm giving you the right to sue me if I breach that. That's what those two things are. So I'll look at them in turn. There's a few little extra rules to note. The key thing to note, by the way, for the purposes of this area is this. It's when it occurs. Okay? It's with the time. It's the relevant time matters. That's the things you need to note here. Because it's easy to say, oh, it's when it's disposed of. Well, no, it's a little bit more than that. It's not uncommon. Lee, you've bought houses down there, haven't you? Have you bought a house, Maddie? I'm not sure, Maddie, whether you've bought houses or not, but selling it currently. Oh, there we go, Maddie. Yeah, you'll get there. So one thing to note, contract date. You got it. So the key things to note, the contract date. Look, Steve used to put this in the exams. He said you would have like, oh, the contract was signed in May, but the settlement date was in August. We don't care about the settlement date. We care about the contract date in regards to A1 CGT events. That's just what it is. So that's a piece of information. You need to know it. C1 is when things are destroyed. Look, this is a little bit weird, and I couldn't find anything. If anybody wants to find out, it's this one here. The reason for that is that when your asset's destroyed, the default rule is when the time is when you get compensation. So if it's insured, when you get the insurance payout. If you're suing somebody because they've damaged the thing, then it's whenever that happens. Now, if you have a situation where you're not getting compensation, the asset's not insured, it gets destroyed, it occurs when it says the statute says when the loss is discovered or the destruction occurred, but it doesn't say which of these you go through and do. So the ordinary principles of statutory interpretation would suggest you as a taxpayer would choose of those things. You would actually get to go through and choose where each of those things there. Yeah. So that's just something to note, but I couldn't find. So if anybody finds any sort of literature, so to speak, in regards to that, yeah, I'm all ears on that one there. All right, D1. This is a little bit more unusual. This is where you create some form of right, and ultimately that right is the right for the other entity to sue or bring an action against you. So if you give somebody the right to sue you, it's really how that works, then that is a CGT event D1. And again, it seems like a bit of a corner case, and look, it probably is. And compared with all of the other CGT events, of which there are like 50, probably is. It is a corner case, but sorry, they are more corner casey than this one. There are many, many, many other types. We don't care about them for the purposes of this subject. So that's where we're at. And look, if people want to go and do honest theses and bits and pieces there, you're welcome to go through and do that. And there's a whole variety of more, but I don't think it's worth anyone's time and brain power to do that. Okay, so that is assets or types of assets, and that is events. That's the CGT. All right, so once we've established those things, we've got some asset, we've had the relevant event, how big is that capital gain going to be at any given year? So for each asset, we need to determine what the proceeds are. That's usually the easy one. How much money did you get? And then in order to determine the gain, we have to work out what was the amount we spent on it. And there are some quite complex rules for that, and they all involve this phenomenon known as cost base. Now, you find the proceeds and subtract the cost base to determine the capital gain for a particular asset when a particular event happens. And cost base has 5 elements, and I'm going to be perfectly honest and blunt. I've made these words up. All right, where I talk about those things, largely because when you read the legislation, it just talks about the first element, the second element, the third element, the fourth element, and the fifth element. They're not very descriptive, though, as far as I'm concerned. So as a result, that's why I've tried to describe them a little bit better. And it wasn't until a little bit afterwards when I realized when we talk about cost base, the first one I actually called based costs. You can remember that because it's a little bit silly. Oh, Bulldog scored another goal. I'm happy. Okay, so what you do is when you are making or trying to determine whether you make a capital gain, is you look at the proceeds, so the amount of money you got, and take away the cost base from it. And unfortunately, this idea of cost base is different for accountants as it is for law types, unfortunately. Sometimes the accounting principles are the same as the law types. The situation is not. The main one being that when we're working out the amount that the asset costs for capital gains purposes, we're actually looking at the cost across the whole life of the asset, both the time to buy it, the time having it, and the time disposing of it. And to make it worse, unfortunately, they've changed the rules of this along the way. So they changed them in 1992, they changed them in 1997, they changed them in 1999. They've been pretty good over the last 20 years, thankfully, but it took them a little while to get this right. So there's a few gotchas, and I'm just going to go through really to talk about the basics of this stuff here. Note though, and this is going to sound a little quirky, when you're calculating a capital gain, you look at the proceeds, all right, dollars of proceeds, and then we look at the cost base, all right, CB. So you take that away from the amount that you got, sure. However, when we're looking at tax losses, you still look at the proceeds, but the amount that we take away is calculated slightly differently. It's called the reduced cost base. And certain types of expenditure are actually excluded from that. So you can have a situation where you're calculating the capital gain and it comes out as negative, all right? And so you're not going to have you didn't make a gain. In theory, you made a loss. Then you go and calculate what the loss is. It's a two-step process. They're not symmetrical. Sometimes you can do that and actually have that being positive. So it is actually possible to have no gain. So you've got Bordeaux scored another goal. Great. Where you've got no capital gain, then you have to go and calculate whether there's a capital loss. It is not a symmetrical equation because when you're calculating a capital loss, you actually do slightly different calculations using this reduced cost base as opposed to cost base, the way that that's described. So I know it sounds a little bit weird. These are technical terms. That they use the word cost base to describe gains, or rather the amount you take away from proceeds. Then I'll put a score another goal. Oh, they're on fire. And when you're calculating capital losses, you've got to use this reduced cost base. I know this is confusing. I know it seems really dumb. I don't know why Parliament did it this way, but ultimately you can have situations where you haven't made a gain, but you haven't made a loss either, in which case it's fine. The amount's just zero in regards to those things, but it can be a little bit confusing to calculate. All right, so we're going to go through each of these 4 elements in turn. The base cost is arguably the easiest bit. That's the amount you paid for the asset. You paid a certain money for an asset, and that's the amount that goes in the first element. It's pretty straightforward, really. Um, uh, oops. So let's just say, far out. No. No. Random people calling me. So, sorry guys, I'm just going to have to take a second. Just a second, guys. Apology for that. So, apologies for that. The first element involves the base cost, the amount that you paid. Yeah, sadly. Now, there is a rule, and look, I have to apologize for the people who are watching this, who watched this during the lecture, because I didn't write this out very clearly in the slides the first time I did them. I was up to almost 2 a.m. on Monday doing those, so I really apologize for that. There's a thing called the market value substitution rule, because it works symmetrically. If you are given an asset for nothing, then they substitute the market value of that particular asset. Also, if the amount can't be valued, then they'll substitute that. Or if the parties don't deal at arm's length. So that occurs in situations where, for example, there's reduced consideration. So, Stacey, if let's just say you're my favorite cousin, if I sell you my house for $100,000, that's not going to be an arm's length transaction. Therefore, the market value of the asset is used in regards to the base costs. That's just the way that works. Okay, if that makes sense. That's how and where that goes. And that's the market value substitution rule. And I apologize because it wasn't in that wasn't in the slides to start with. It's actually a pretty important rule. So you don't think you're going to be able to go through and do that. Right, second element, an incidental cost. This is the cost when you are acquiring it. So this is all of the professional costs. So you've got to hire lawyers, you've got to hire valuers, you've got to hire real estates, you've got to hire a variety of peoples to go through and coordinate the particular transaction. And that's those fees form part of this second element. Look, there's a reason why we're separating these things out, because the rules changed over the years. So we'll see how and where that sits. Advertising things, and this is both. And look, I guess it's an important point because it's not very accounting friendly. It's both acquiring and disposing. Okay, it's both of those things. Both when you get the asset and when you sell it, both of those costs go into cost base. All right, I know it takes a bit of time to get your head around that. Oh, Bullock's got another goal. They're 22 up. So excited. Okay, and the stamp duty. Stamp duty is the same as transfer duty. So you've got professional services. Stamp duty is when you're transferring the asset. When you're purchasing the asset, the purchaser pays stamp duty on it. So Stacey, you would have been presumably exempt. Don't want to try and guess how much your house cost, and I don't need to know, but you're exempt up to a certain point in terms of, yeah, good. Proud of you. Well done. And you have to pay. So if, for example, you're purchasing it as an investment property, you have to pay a higher rates of stamp duty as part of that. It's a percentage of the sale. You actually pay stamp duty when you buy motor vehicles too. Again, that's expressed as a percentage of the vehicle. Advertising it, and also the loan establishment fees. Now, interest is different. The interest you pay over the time of the money you borrow is different from the cost of setting the loan up to start with. Okay, that loan establishment fee, that forms part of the second element. Now, the third element's the tricky, because, well, a couple of reasons. When you own an asset, look, and I'm going to tell you, look, I've got it as an exception to this later on, but I'm going to tell you now why we treat this one separate, why this one's unusual. Because if you think about it, ownership costs, paying interest on the loan, paying maintenance, paying for repairs, insurance, rates and land tax. In most situations, if you've got an asset, and you've bought it for investment purposes or business purposes, what's important to note about these things here? What are these? If this was a business, you've bought an asset, you bought, I don't know, a factory, and you've had these ownership costs. What do you get to do with those if you're carrying on a business? Yeah, exactly. You would get to deduct them, all right? But here, they're also going to cost base. That doesn't seem to work very well, because then you're essentially getting this double dipping aspect to it. Don't get me wrong, when we get to the rules later on, you'll realize that stuff, a lot of the stuff doesn't come out. And the key thing they say is that, look, you do get to include this in cost base if you can't deduct it. Now, that's different from if you, that's, maybe I did explain that very well. So if you do deduct it, or you could have deducted it, can't form part of cost base. But these costs, if you can't deduct them, and that comes up with things like our own houses. Okay, so if you buy or have your own house, these are the sorts of things that you have, and these are the sorts of things that you will be able to put into cost base as part of that. And note that this only applies to assets after 991. Yes, this is one of those quite a few dates that they have where they change the rules. All right, so if you have a holiday home, for example, well, yeah, we'll talk about exemptions, but that's basically it. If it's for income earning purposes, then you bought an asset for income earning purposes, you could have deducted the amount. Well, if you did or didn't, doesn't really matter. You ain't going to put that in cost base. We'll get to that in a second. All right, the fourth element, though, is this preservation cost. So that's where you need to maintain or even increase the value of assets. And that includes installing it and it includes moving it as well. That's the fourth element. That's just what that is. Fifth element is legal costs. That's where you are defending title or establishing title to the asset. If you're having to fight legal battles, this is where that the element where these things go into as part of that. And so why do we care about phrasing them in terms of these different elements? Well, different eras have different rules. So that what I'd said about tax deductions, any element, so any element where you could have claimed a tax deduction and the asset was acquired after 1997, you can't put that into cost base. Okay, that's a pretty handy thing to know. Well, not handy, it's not great. It's not great for us taxpayers. So if you could have claimed a tax deduction and you acquired it after 1997, if you acquired it before 1997, and you could have claimed a tax deduction, but only in regards to the second and third elements, then they can't form part of cost base. Only those ones. So basically, the first, fourth, and fifth elements, if the asset was acquired before 1997, you can still go through and use those, even if you could have deducted it. Another thing to note, this comes up in either situation, if you get recouped, so in other words, you've spent some money, but then the insurance company's paid you back. Well, it's not going to form part of cost base. You got the money back, so we don't count that at all. So if the money is recouped from a third-party insurance company or employer, you don't get you don't include that in cost base. Okay, now I talked about cost base, which is what you use for determining a gain. Then there's a thing called reduced cost base, which is when you're looking at losses. Okay, and there's two things to note about that. Regardless of when the asset was purchased, if you could have got a tax deduction for an amount outlaid, it's not going to form part of the reduced cost base. So if you had an asset that was purchased before 1997 and you're trying to make a capital loss on it, you can't count those amounts. They don't form part of cost base, that particular part. And the ownership costs, when you do this calculation, if it is a depreciating asset, so if it's under division 40, and you're going through to try and calculate the reduced cost base, again, this is to try and work out capital losses, you have to include the balancing adjustment, which we did last week as part of that. You've got to put that amount back into this calculation as part of that. And I'm probably going to have to do a few equations with that because I don't think we do them for the tune. All right. So this takes a little bit of getting your head around this idea of cost base and having these elements and having the idea of some of these items you can claim and some of them depend on where the asset is acquired. That's a tad unfortunate. It's because we've changed the CGT regime a few times over the years. And the key thing to note is that that is different from the accounting idea of cost base. It's a different concept. Here we're throwing absolutely everything. The cost to buy it, the cost to install it, the cost to sell it, all of the things involved with that. We're throwing all of those things together because ultimately all of those things thrown together are subtracted from the proceeds. And that's the amount that we're going to go through and have to include as part of our capital gains. Let's have a chat about exemptions. Hey, Stacey, how much CGT are you going to pay on the house you own when you sell it?
Am I a bad person if I don't know?
You're not a bad person. Nice try. It's nothing. Why? Because the federal government decides, and it's infinite wisdom of the government, the Parliament, Commonwealth, they decided that to give an outrageous series of exemptions. And like it is a little bit funny. It's funny when I look at this because look, I don't know if you're aware of this. New Zealand doesn't have capital gains tax. It's like political suicide to think about it. And it's had disastrous impacts on the social fabric of the country. Now you've got this very huge gap between the haves and the have-nots. And I'll probably spend a non-trivial amount of the rest of my life fighting this particular injustice. And it is an injustice. And what you get though is that people have these proposals and these outrageously watered down, stupid situations where you've got your family home exempted. So your family home can be $2 million. Oh, and it just gets an exemption. Well, what was the point? What was the point? And so that's kind of what happens here. Your dwelling, if you're a taxpayer and you have a dwelling, any gains or losses you make on that are disregarded. And I kid you not, if you move out of your home and you let your relatives sleep there or whatever you do, this exemption, if you don't derive income from that property, lasts forever. If you do derive income from it, that exemption still lasts for 6 years after you move out. And to make this funnier, you can move back in after 6 years to reset that clock. And people do. I've known people that do this. They move back into their rental house every 6 years, stay for 6 months, because that's what you can do in order to reset that clock so you do not pay capital gains tax. I kid you not, people change their lives based around tax law. If anyone tells you that taxes don't drive incentives, they're wrong. They do. People do change because of them. And that's a helpful thing to know. There you go, Stace. So eventually, if you do move out, you buy another house, you put it in your name, and you rent out the house you've currently got now. Yeah, I bet you'll think about it. Think about moving back there in 6 years' time. The thought will go through your mind. You will. Yeah, well, there you go. And if you do, that house will remain exempt from capital gains tax. It just is. That's how that works. Yeah. Also note that we've got large properties. It's up to 2 hectares. Technically, it's actually 2 hectares including the dwelling. But those 2 hectares, provided they're used for private or domestic purposes. So you've got farms, so the bit around the farm, if that's not used for farming, then that won't be subject to CGT either. And you map those 2 things out. Just draw a little diagram and send to the tax office. Okay, so MRE, it's known as the MRE, by the way, if that comes up. You hear that phrase? Main residence exemption. That's what that is. All right. MVE, motor vehicle exemption. This one's real easy. Is what you are selling a car or a motor vehicle? If it is, no CGT. That's a rule. There you go. Tuck that piece of information away. I told this joke in class. It's not a very funny joke, but I'll tell it again, which actually wasn't my joke. It was from when I did this as a student, which was in 2011. So it was 11 years ago. And that was the one lecture when Van Lee's father-in-law had passed away. So she'd gone to Melbourne, and Steve taught the class, and he was talking about capital gains tax on vehicles and said, oh, well, I'll put Steve's voice on. Well, when you have vehicles, you're never going to sell them for more than what you paid for them. So it's not really much of a problem. And I stupidly put my hand up and said, well, actually, Steve, I once bought a car for $300 and sold it 4 years later for $340. And quick as a flash, didn't miss a beat. Steve's like, yes, Simon. And then you retired the next day. Smart ass. Anyway, I haven't forgotten that story because it's like a lot of things that remind you of particular moments. You will remember the rule based from the story. And in this case, when you buy a car, it does not matter what you sell it to for. It is not a personal use asset. It is not subject to CGT. I'd like to say I was hilarious. That's why they kept me around here for so long, Stacey. Thank you for asking or telling. Yeah, you guys may not find me as hilarious as others have, but uh, I I don't do this for the money. I don't even really do it for the prestige. I don't even know why I'm here. I do it for the laughs. It's great. Life is about laughing. So recommend try and do as much of that as you can. Have a good peer group. It makes a big difference. Um, anyway, so that's the second exemption we have from that. Third one, depreciating asset. This one comes up more than you might think, and you've got to be a little bit mindful because look, if you've got a capital gain or loss on a depreciating asset, okay, and you've got a balancing adjustment as a result of that, which you will do if you've got depreciated, you've depreciated something, you've got a balancing adjustment, and you're an individual, okay, then you will disregard the capital gain. And look, ultimately, this is because where you've got assets that are depreciating, usually you're using those for the purposes of deriving assets. Those are assets that are used and have usually diminished in value. You've claimed some depreciation. You're going to have a balancing adjustment. So if you've depreciated something, right, then you've got a balancing adjustment, right? You have to declare that as income, mate. It's not a capital gain. Remember, capital gains are treated a little bit more favorably than income. So you've got a situation here where if you've got a depreciating asset and importantly, if you're an individual, okay, then where you're also a partnership or trust where you're an individual and you're a beneficiary and so on, yada yada. But if you're an individual, you will disregard that capital gain. Does not apply for non-individuals. Okay, so compliance superannuation funds for companies, the main ones. Okay, so just make note of that. Depreciating the assets, because that again, that's probably going to come up quite a lot. What assets don't depreciate? Land doesn't depreciate. Shares in companies don't depreciate, and those are often the ones where you're going to be dealing with CGT events, and obviously rights that we create in other entities. So those things, just make note. Look, I haven't written the questions for the test for this, but a chunk of them are going to involve packets of shares. So leave that one in the back of your mind. Okay, CGT, how do we work it out? Well, every year your net capital gain is included in your assessable income. That's this generic rule that we have or we use in order to describe how capital gains work. And when you do this, okay, so if you've got proceeds, or usually have proceeds when you sell an asset, you take away the amount of whatever capital gain that you have from that. Now, we've got a few things we've got to learn here, and I'm going to try and explain this as best I can. First rule is that if you've got a you're making a capital gain, you use cost base. If you're having a capital loss, you use reduced cost base, which is slightly different numbers that end up going into each of the elements. And you do this calculation for each asset. Hi, Claire, how are you going? And so that when you're doing this calculation, you'd have to do it for each asset. And you can go through and to do this. And the idea is that you do this calculation for each asset. If you can use indexing, you can then index them to work out the capital gain on that asset. I'll explain what indexing is in a few minutes. Once you've done all of those steps, then you've applied capital losses from assets, either in the current period or bringing previous losses forward into the current period as well. Then items that can be discounted, we will discount. So that takes a little bit of getting your head around. It's that idea that when you're calculating the capital gain or loss for each asset, if it can be indexed, you index it at that point. And once you've done that, you've done the indexing for assets that can be indexed, and not all of them can, then you can apply losses both from the current year and from previous years against gains that you've got. Then, once you've calculated the aggregate, if it's still positive, in other words, you've still made a capital gain, for things that can be discounted, then you apply the relevant discount rate. So I'm going to have to explain each of these in turn. I'm going to have to explain what a capital loss is, what the indexation method is, what the discounting is. So we'll start with the capital or carried forward capital losses. A little bit like carrying tax losses forward, but it's a little bit more favorable. And the idea is that if you have a capital loss in a particular year, you can keep that and carry it forward to subsequent years. My ex-partner who purchased a unit, she sold it for significantly less than what she paid for it, had a capital loss, can carry that forward. And it's not, it's not uncommon for taxpayers to go through and have that. You buy things, you sell them for less than what you pay for it, large capital assets, you get the tax benefits of that. No, it's more favorably than income in that you carry them forward indefinitely and you can apply them. You do have to apply them from last in, so you remove them, the older ones from the books first, but ultimately because you can apply them in part, it doesn't really make much difference. So if you made a loss 10 years ago, 5 years ago, and 2 years ago, technically you have to apply the 10-year-old one first, but because you can do them apart, it really doesn't make much difference as part of that. So that's a pretty, I think, a pretty straightforward sort of concept. What is not a straightforward concept is the indexation method. Okay, now breathe, because this is complex. And I probably should explain why this exists and why you need to know about it. But thankfully, every year that goes by, you'll need to know about it less and less and less. When they brought in the capital gains regime in the mid-80s, right, and they're trying to work out how to calculate whether you made a capital gain or not, you've got to appreciate that the face value of assets in many situations was kind of useless. Why do you think that would be in the year 1985? Why do you think trying to work out the gain on the notional, the face dollar value of assets would be kind of pointless? What's the phenomenon that was quite big in the 80s that for most of our lifetimes, Claire's, no, not quite, no, GST, over there, no. What's the phenomenon that reduces the purchasing power of money? This is one of those 20 questions things. You can ask questions. Oh, I love it. So if I purchased something for $100,000 in 1985 and I sold it for $104,000 in 1990, did I? There we go. Got it. Thanks, Maddie. Cheers. Yeah, if I did that and I sold something for 4% 5 years later, I'm not making a gain. Like I've essentially lost money. Why? Because inflation was rampant in periods of the 70s and 80s. Inflation sucks. Inflation is the reduction of the purchasing power of money. Your money, the same $1 is worth less. Okay, that's what inflation is all about. Even though we phrase it as a percentage of something increasing, ultimately it's not really about the prices increasing. It's about money being worth less. Everything is worth exactly what someone's willing to pay for it. So, because inflation was big in the 80s, they thought, well, when we set this thing up, we're going to have to take into account inflation, which is what they do. So they have, as part of the discount capital gain system, which they had in the 80s, indexation amounts. So you'll have an amount that'll be, 63.5 for one quarter, and then you'll have um, uh, another one which is 61.2 or something along those lines. And the idea is that when you multiply those two things together, it's a number that's slightly more than one, something like that. I'm making that up. That may or may not be the case. And these numbers are published they were published every quarter. And so that this the CPI, in which here we're talking about the CPI, it's for the quarter. And so you find the CPI for the quarter where you bought the thing, and you find the CPI for the quarter when you sold the thing, and you take those two numbers and you multiply them together. You'll get a number which is, in most situations, is greater than 1, and you multiply that by the original cost base. So you multiply those two things together, and then you get the indexed capital amount. You take that away from the proceeds. That is the indexed. So that's the indexed cost base, and you take that away from your capital proceeds to work out how much you actually made, taking into account inflation. That's what the indexed method is all about. It's basically looking at what actually the gain was. If you had just put this money in the bank, plus or minus interest and tax and so on like that, and you left it for a few years, really you wouldn't have made anything. That's kind of the point. Does this kind of make sense to you guys? Because really this is a phenomenon. I'm not going to teach you how to do the formulas. I don't think it's worthwhile, to be honest. I don't think this is a worthwhile use of your time. And if you talk to any student that's done tax law in the last 20 years, and you tell them that, yeah, the lecturer said, yeah, there is this indexation thing, and he talked about it and ranted on for about 10 minutes, then said we didn't need to be able to do any formulas, and they go, oh, lucky you. Because you ultimately, and this is really important here, you can only use indexation on assets that you acquire before the 21st of September 1999 at 2:45 p.m. I think it was, when 12:45, it's when Peter Costello walked out of cabinet and said, we're changing the CGT rules, and he looked at his clock right now. That's how that worked. So if you look in the Act, there is a very specific time. So if the asset was acquired before that time, you can choose to use indexation or the new method, which is the discount method. You don't double dip, you can't use both. And I guess another important point to note is that the indexing, so this CPI for the quarter, has not changed since the September quarter in 1999. What does that mean? It means that even if you choose to index a capital gain, it won't take into account, I kid you not, any inflation that's occurred since the 30th of September 1999. So the only time you will ever need to use the indexation method is if you have an asset that was bought in the 80s or the 90s, and it hasn't increased much in value. Because if it increased a lot in value in that time, you get to choose to discount it, and you're almost certainly going to use the discount method instead. It's only if you bought stuff in the 90s where you want to use the indexed method for CGT calculation. Okay, that's just one thing to note. So if you do have an asset and this does come up in practice and it has been purchased between 1985 and 1989, yes, you're going to have to go through and do this method, find the CPI values, do the calculations, work out what the thing is. Note that once you've done that indexation, you can't discount it. So it's only usually going to be worthwhile if something's been bought and it's only gone up a little bit, like less than the inflationary amount. And you can appreciate over time that becomes more and more of a corner case. Okay, so that's why we don't spend too much time on that, but we do spend more time on the discounting amount. Now, there are some important gotchas for discounting. It goes like this, by the way. If you buy something, so let's say, for example, Stacey, I'm going to say, let's just say Stacey bought her house, and I'm going to say, and I'm making this up, I'm going to say you bought it for $300,000, all right? So, and it's in your name, $300,000, pay your stamp duty, blah, blah, blah. All right. If you, in 7 months' time, you sell it for $400,000, good on you. What's your capital gain? What's 400 minus 300? Yay, good. Okay, good. Paying attention. Okay, good, good, good. We're awake. And that would be $100,000 capital gain. If it was less than 12 months, you are adding $100,000 to your assessable income. Okay, now again, you would be able to include in this though a variety of those costs, things that you couldn't deduct. So your cost of ownership, your cost of acquiring it, your cost of this, that, and the other things. It's probably going to be less than that. But assuming that including all those things is $300,000, you're going to have to pay 100K. So if you held that for 12 months or more, though, so let's say you've now sold it for, you decide, look, the offer was 400K. We won't do that. We're not going to do that. We're going to wait another 2 years, and this time you get to sell it for $450,000. There, again, going back to your cost base, leaving aside the cost of ownership and other bits and pieces you've got, assuming that that was in there, you'd make a gain of 150K. But because you are an individual, you get to discount that amount by 50%. And you do that at the end. So it equals $75,000 that will be added to your assessable income. That's how that works, because the discount rate for individuals or trusts is that. It's this amount for super funds. And what's the amount for companies? It's that, which I thought when I first studied tax law that was stupid. Now I'm a little less sure, largely because gains from companies, gains and loss of companies, well, ultimately your companies are passing things through to shareholders anyway. You've got an imputation system. Oh, boo, Melbourne's got a goal, boo. Bulldogs only winning by 3, boo. Okay, so that's the disc. And look, I have to be honest, you do have to know this rule. This is a pretty important rule because this is how we do things. We don't look at inflation. We're not concerned about that since 1999. That, I think, came about because in the 90s, the reserve banks all sort of got inflation under control, so there hasn't been much. Ironically, now we're going through a period of inflation, and who knows, maybe these rules will come up. Maybe people start complaining, but probably not. Okay, and this, I've got to say, is actually, this slide is the final slide. It's the last thing I'm going to talk about before we do the jute, which is the compiling of losses. So how you go about doing it? Well, the Act actually says you can you can apply gains and losses in any order you like. And this is true, but you'd be mental, absolutely mental, when you've got a capital loss to not offset that against a capital gain, which is not subject to discounting. So if, for example, Stacey had 3 assets, Going back to Stacey. Thanks, Stacey, for turning up. It's really good. Now I've got examples. So, Michelle, I'll use the text. I'll actually use the texty thing. So let's say you had your house, which you made a 300K gain in 7 months. No, sorry, 100,000 gain, 100,000 gain in 7 months. Then you had your, you've got a 70,000K gain from over 4 years, 3 years, and 50,000K gain over 5 years. So let's just say you've been really busy and you've made all of these transactions, and you've got $100,000 $1,000 loss. Let's say you had those figures there, because you can't discount gains that have been made or you haven't held the asset for more than 12 months. If you have losses that are carried forward, you ought to apply those against the losses you can't discount. You want to do that first. That's what you can go through and do. So here we would take this 150,000 loss, apply it first against that one, and then a little bit of it against that one if we want to. Maybe you don't actually have to. You can choose to roll losses forward or apply them in part as part of that. So the idea is that if you do go through and you would apply that, so the net result is you would only make a gain of 70,000, and then you would get to multiply that by the discount rate, which would mean as a result you'd only pay or tax on an extra 35,000K. That's the amount that we added to your assessable income. That's ultimately what capital gains tax is about. Yeah, a couple of other little rules that I mentioned before about collectibles. You can't, if you make a gain of collectibles, you can only offset that against, sorry, make a loss from collectibles, you can only roll that forward to count against other gains from collectibles at a later stage. Does that kind of make sense? Like that? I know look, basically there's a lot of information. I suggest you go over this one again. This one is, once it clicks in your brain, is actually pretty simple. Other than the stupid rules for dates. So if you're dealing with assets that you've been acquired in the last 10 years or so, it's pretty straightforward with a whole bunch of got yous for